Hey, good morning, everybody. Welcome back from a three-day Memorial Day weekend, and thanks to once again for all our veterans out there. I think Person's Planet, in honor to all our veterans, gave out, which was something very unique. Instead of all the mattress sales and all the other special sales that were going on this Memorial Day, we actually offered something free to all our veterans out there in our appreciation. And I know a lot of you had emailed and expressed us back your gratitude, not only that, but also your history. So we extend our thanks to you, and it's the least that we can do, and hope that you find the information a great refresher for those that are here currently in the room, and of course for those that are looking to understand what technical analysis is or what trading's about. With that said, we now have a shortened holiday week. We're going to put 5 days worth of work in 4 days. The weekly thoughts and observations on holidays is not done. I might come out with a mini one later today or tomorrow morning for us, but in the meantime, with such a shortened day, I really don't think there's a need for having the market has rallied a huge amount of work done for a 4-day work week. With that said, I want to point out a couple technical tools that we look at. One is with last week's strong rally, the daily Mcclellan oscillator actually fell. So there's a couple other items which would be counterintuitive to a lot of people believing that the market had strength. We had a couple plans of attack with a few stocks, Hewlett-Packard. We did have a ratio back spread in place, hopefully Friday, which we talked about in the room, to unwind that. And for those who are long, definitely dump, and hopefully that did you used your own short-term indicators for that, because we'll go over that in a minute. It really gave a nice sell signal at near the top using both a 15-minute and a 60-minute time frame. Approximately 10 o'clock in the morning on Friday, I think 10:30, sometime in that range. In the meantime, I'm really kind of looking at two situations that have occurred over the last few weeks. A, the fact that the market has rallied and that we've seen a breakout in the relationship, and this is my spread chart, and just to kind of see how the market went through this longer period of, I would say, wedging higher. As you can see, it's more of a wedge up ascending support level, and you can kind of see what I'm referring to here if I get rid of the color. So, you know, it's more like a wedging base type formation. Of course, you got a little bit of it accelerated to the downside and it's popped its head a couple times, but overall pattern is more of a wedging. In the longer term scheme of things, you can kind of see that that's exactly what's been going on here, is that the market has had a few down drafts, and it's consolidated, it's broken out, and it's consolidated. And at this point in time, we're breaking out, and I think we're kind of what I thought we would see by the end of May, a 5% year-to-date gain. I think we have to say, you know what, it may have come close, and that's about it. Two things that I don't like about the market here. Number one, the weekly Mcclellan oscillator with last week's strength. If I didn't share this with you guys, you probably would be, and I think a lot of traders out there may have been a little bit caught off guard, but the fact is that both the daily and the weekly Mcclellan oscillator fell. That, to me, is a danger sign, because while we were thinking that the market would get into an overbought territory, we did cross below the zero line on a weekly basis, and of course the week we got to wait till Friday. But the fact is that the daily did such a disastrous downturn off of that high. While prices made a new high, it shows a lack of participation with a lot of stocks. Therefore, I see at least a few days downside action in the stock market. So I'm not looking to buy breaks right away, and I'm not going to pick the bottom on this one. I'm just going to hang out a little bit, and I would certainly tighten up stops, and I think it might be still, for index, let me reiterate, for index trading, for day trading, I think selling rallies might be the cause of action here. Let me take a look at our strength weaknesses with individual sector and stock market indices. And this should come up real quickly. So looking at the Russell what I was doing with the IWM, we did form in the Russell a daily low close doji. Interestingly enough, while the AD lines didn't break out and the volume levels kind of downturned, the weekly in the IWM has always and has been in a sell mode. Ironically, here we have almost an engulfing pattern, and we came really right up to the midpoint. In order for the Russell to get more bullish, it's got to get a close over that high again. That's the engulfing candle right there. You can clearly see it. It's the last conditional change, and it is acting as resistance. So here's the key. If we get and I'm not going to look for a daily close, a weekly close, I mean, but I'm going to be looking for a daily close underneath this red zone. Right now we have a low close doji. I think we have some follow through weakness. We had lack of volume with tiny move, which portrays more potential downside action. Seasonally we go up, it looks like, going into the 1st of June. So maybe this week we kind of grind sideways, but boy, after that, look at the Russell. It just falls off the cliff going into the best seasonal time frame for small cap in October. So the fact is the Russell's been trying to break out. It's tested, it's tested, but it hasn't gone up, and it hasn't gone up with any volume. It hasn't gone up with any advancement, and to me that's a little nerve-wracking. So I did want to put everyone for a reasonable expectation, a high alert in the marketplace, and I think I'm not the only one that senses that, because now we can see that the market is kind of breaking down a little bit, 21.17. So with that said, a couple things. Number one, we had a bond market which shot up, and if we go to let me go to this page right here. So I think first and foremost with the planning and scanning, everyone can get the idea. I'm looking for at least today, tomorrow, until we see how far it wants to go and what the conditions is when it gets down. Number one, we're selling rallies, okay? That's number one. Number two, I don't know how much this is going to manifest into, but from the downside, but we have been talking about the bonds since this bearish or bullish convergence, excuse me, on volume. Price made newer lows. We got down near this kind of like longer term, the monthly support in the bonds. And I said, even in Las Vegas, some of you were there, my comments, and I even made comments to that, to the effect in this trading room, that we're going to go through that pattern that I wrote about in my first book, where we go through a trend and then we go through consolidation. And I wasn't looking for the market to accelerate to the upside, but stay roughly in a trading range. Folks, that's the condition, and that's what we've stayed in. So kudos to that. It's kind of like being in a non-directional trading range, and until we break out of this last conditional change candle's high, which seems to be acting as resistance, and it's the high from May 11th, you know, that's about all we're going to probably see out of the bonds. The high in the bonds on the, I don't know which you want to call it, overnight, 155.05. I still think that the bond market, and there's a lot going on here because gold's puked. Puked is a professional term to it's not trading at 1226, and we tried to get into gold charts. So anyway, let me before I move on to gold, let me finish with bonds. Bonds, until you actually get a move up above that last conditional change, I'm not really looking for a whole lot of material action, but I still say that the bond market can see some upside from in here, okay? So at least go back and test this tweezer top, this equal and opposite, yin and yang. Bonds never, as you can see, they've kind of arced into a bottom, and you can kind of tell that the volume action has been pretty decent. Commitment of Traders report, one thing that's very interesting is that the small speculators and the commercials, which are almost, I mean, if you take a look at the zero line, which is right there, okay, the commercials are barely short this market. And so it's neutral to the commercials. So the difference between the longs and the short are the hedge funds, the professional traders, and of course the small speculators. And I'm pretty sure it's going to be resolved by the commercials maybe flipping into later. We won't know this until Friday. But if you see the market surge to the upside, my bet is the small specs get squeezed, commercials kind of cover some of their shorts first, and maybe you get some of the hedge funds, we'll see what they do. I mean, it's anyone's guess. They could flip into taking some profits because they've actually, as you can see, they went from being real long to kind of neutral on that downdraft, still kind of long, but then really accelerated their holdings into this zone right here to the upside. So the balance between this war is hedge fund speculators. With the volume action and my analysis, I think we see a little bit more upside, 1.5, 2 points, something like that, and we'll see what happens up at that last conditional change. If you're a bond trader, how does that impact the rest of the markets? Well, that means interest rates go down, bonds go up. Interest rates go down, bonds go up. So what does interest rates go down affect? Maybe the dollar. And when we take a look at the dollar, and I know I had this, if the market got down in the gold, and it was a very choppy trading range in here. One other example that I want to talk about is that seasonal trend. Let's get the commitment of traders up again. And so what I like to do is the large specs, which are the hedge funds, I put them in blue. Small specs, I like to put them in green, and I like to put that in a histogram, and then we call it a day. There we go. All right, so small specs and hedge funds are long, but the funny thing is in the gold market, from a longer term perspective, we're just kind of still in a flat top range. While we were in Las Vegas, we tried to do a credit call spread here, and the fact that they wouldn't fill us and the market actually traded higher. So when you're trying to sell calls and the market rallies, that's generally a good sign that the market's not going anywhere, or it's expunged its rally. An old floor traders, or one of my keen observations, I don't know if it's a floor trader's trick, but one thing that I noticed when I tracked and actually was looking at option valuations, when the market went up and puts went up, it was a telltale sign that the market was going to go down. I'll repeat that. When prices rallied and puts went up in value and calls went down in value, it was a telltale sign. It was like an internal kind of contrarian indicator. Professional traders aren't looking to write a whole bunch of puts, they're covering. And so with that said, this market, at least in gold, it's been kind of a tricky, choppy trade. It really has. I mean, it breaks down, it doesn't go anywhere, it zings up, and then 2 days later it comes back down, it consolidates, it goes right back up. This is a very tricky trade, but longer term, if we change to our weekly charts, you can see from a seasonal perspective, this is really not the greatest time to be buying this stuff, that's for sure. And we can also see from the volume patterns that there really isn't a lot of interest in picking gold up either. I mean, it won't go up and stay up, and it won't go down and stay down. It's kind of consolidating. The volume patterns pretty much mirror the actual chart patterns to a degree that you can see, except for one main fact, that when the market rallies, we have a kind of this flat line resistance, and then when the market rallies, we have lower highs in volume. So needless to say, gold, if in my opinion, if we break and close below this swing low again, 1172, my guess is after this time frame of coming in, of trying to rally, my guess is that based on the technical indicators, that we're going to try and come back down to this baseline of maybe 1140 one more time. That's my outlook on gold. The worst, the seasonally best time of the year to buy gold is in July. It's now the end of May. That's a long time to see what gold wants to do. The fact that there's not really been any volume accumulation on that rally, that's the story on gold. That's all I have to say there. As far as other markets of interest, looking at crude oil, and of course, the interesting aspect is when we take a look at interest rates, and we say if interest rates go down, then you can look at the lack of connectivity and the intermarket relationship between these markets. Gold goes down, the dollar goes up, the bonds go up, and you sit there and go, wait a minute, that's not normally what really transpires. When the dollar goes down, when the dollar index goes down, then we see what? Bonds go up, crude goes up, golds go up. So we are seeing a disconnect in some of that old school stuff that everyone seems to have been relying on. And folks, this is where it gets a little bit interesting. We've got central bankers interfering with the world of trading, and that is one thing that we have to make aware of. The Fed, they don't want to see the dollar, and I think even Janet Yellen, correct me if I'm wrong, made comments about euro currency weakness and not seeing it too weak. And the Euro Central Bank doesn't want to see it too strong. I mean, it's like, okay, so what does that mean to us possibly? It means possibly that we're going to see the market in a wider trading range. Now, we did form, if I get rid of the pivots, on a weekly basis after a small little rally. It wasn't a whole lot, but we did form a weekly low close doji, not a lot of volume. Specs are short, commercials are long, hedge funds are short. I don't really see a lot happening one way or another. Easily we can come back and test maybe the weekly pivot support, 107. I mean, would that surprise anyone? At 107 level, you're also near the low end of, if I got rid of prices, you would see something that would be standing out like a sore thumb, something that I look at. Not absolute price, but moving averages. And you can see that we have a kind of a double bottom in the wave of those moving averages. So moral of the story, I think that, 107, if we do come back down and near that and test that area, then we're coming into making higher lows in the indicator, higher lows in price as well. And so that does, I don't know, it's 180 points, which is, could be one bad, overnight action. When we take a look at the euro one more time, folks, just to cover the bases here, when's a really good, strong time for the euro? Well, certainly at the end of May, it doesn't really do anything. It does bottom in June. We see an upside move as we end the quarter again. Remember, this is a end of quarter. This June is the end of the quarter. And so when you go from the end of the quarter, then you see sometimes seasonal changes. A lot of the seasonalities in currencies occur around end of quarters. I've written about this. It shouldn't be any mystery to many of you that end of quarters is a seasonal event. People adjust, as I've been teaching for 25 years here, to people, individual traders and friends. Hedge funds, we get paid. People that trade professionally get paid on a percentage of profits at the end of a quarter typically. And so that's where we see also corporations, they have to make quarterly adjustments, So end of year is a seasonal event. Tax times, not to get into too much trading lessons, but that is what can compel markets to move. It's not just also earning season. So with that said, bonds to the upside, gold continues to perhaps trade in a range to test the low end of the range over the next few weeks. I don't trust gold to the upside personally. Bond market, I think we can nibble on the long side based on the commitment of traders and volume action. And equities, I think that over the next couple of days, let's see how much further they really might want to go down. It seems to me that with the speculators, hedge funds, commercial short, lack of volume, strong AD lines in some of the markets still. So what that means to me is I don't think we go back below 21, even 2105 maybe. If we take a look at our weekly pivot, the 3-period weekly pivot point moving average, the gold line, is around 2108. And I think that might be a reasonable number to look at. It's also near a consortment of old highs. You can see there averages of prices. And so I think that gold line might be something that we can kind of sink our teeth into. I don't really have a whole lot more except for potentially looking at the option expiration, which we just started that, and looking at the indexes from an option expiration. Perhaps we get a sharp downturn from there to 2,084. And then I think we have one more spike to the upside going into July, the first week of July, and that should be about it. So I'm on cue for caution here in the markets. Last but not least, let's take a look at the crude oil market. So, dollar up a little bit, crude oil down a little bit. We've got gold down more so than the crude oil. But the bonds are up. So the bonds are up. Why? The bonds are up as perhaps they've over-accelerated to the downside, flight to quality, people nervous about the stock market. You know, we still are concerned with, is the Fed going to do I know that the media is pounding the financial media. The average American doesn't care if the rates go up a quarter, a half, a 1%. I mean, I remember I bought a home with 18% interest rates. So the world does move on with interest rates going up. The one segment of the market that's not doing well when interest rates are at zero are those trying to live on fixed income assets and just take a rate of return on their interest payment. That is something we haven't seen since about 2004. Needless to say, the Fed funds rate even back in 03 or whenever it was, don't quote me, it was 03, 04, maybe 02, one of those years. I believe we got the Fed funds up close to, maybe it was 2 or 3, 6%, if you recall. It wasn't that long ago. And we used to focus in on the Fed fund futures. Now everyone wants to focus in on VIX futures and the VX up and the VX down, a new ETF. You know, that's crazy. But it is what it is nowadays. Needless to say, crude oil. The market, to me, comes into a basing action of seasonality. Hedge funds are still very long this market. Commercials haven't wavered one way or another. Small specs, they're not even in this market compared to where they were over a year ago. You can see the green bars. You can barely see green bars here. But they did add a little bit, if I could zoom this up, you can see that the small specs got a little bit of courageous in the last week and went long at the top. So I figure they got maybe 55 in them, somewhere down in here. Let's watch near the pivot coming into this level. What would that be? 56.70 to 50, somewhere in this zone. If we got crude oil back in there, I'd be looking to be a buyer. I think that's, you know, maybe 55 is a little too much, but let's call it 56 on average, an average of 56, whether it's 55.80, 56.50, but somewhere in that range right there. I think any general public, if they started to get long here at 59 and you took a $4 hit on crude oil to, you know, $3, if you bought the high at 60, take off 4, it's 56 bucks. You got the point? The moral of the story is I don't know many small speculators that can handle a $4 hit in crude oil. That's a pretty deep hit. So needless to say, crude oil, if it does come back down, what do I be looking at? I'd be looking more in the lines of still the XOP and oil service stocks. That is something that I'm going to keep my eye on and focus. So looking at the seasonality of the market, we note that while we do see back and forth type of action, overall, we still, believe it or not, go and see highs going into August, hurricane season, by the way. So right now, we might see some downside action in crude, but until the volume really breaks down and until I get, you know, better indications, somehow down here, that's my support target in my outlook. So I just wanted to give you, first and foremost, the main food groups of the markets, the health of the markets of the stock indices, number 1. 2, looking at bonds, gold, crude oil, the dollar, and I think that, and of course the euro, and that pretty much covers the basis of the markets. Looking at one other thing here, last but not least, and to summarize, last week we had a pretty outstanding week, and many people said, boy, you raised the bar pretty high for next week, John. And you know, I've always had this concept that whenever you have a really good week, we get all excited and we want to press it. And you know, sometimes you got to stand back and say, what's going on? Did we have a change in the marketplace? So when I take a look at high close dojis, for example, for the week, and I go, well, what was the big weekly high close doji? Was there any big? We only had 25 stocks. So out of 25 stocks, might be hard to see on this screen. So I'll move it over a little bit for you guys. 1/5 came in consumer discretionary. CVC is Cablevision, a stock that I loved a long time ago. It was a PA stock alert buy somewhere in 2014, something like that. I think we bought it in the 18s, dumped it in the 20s, something. I'd have to go back and look at the statements. But, you know, obviously it had a daily high close doji, seasonally strong period of time, huge accumulation of volume, weekly high close doji, the list goes on and on and on and on. Anyway, I go on and I look at D.H. Horton and I go, this is a sector of the market that I've been talking about, and it is almost time to look at getting into this stuff probably later in June. And the reason is remember we talked last year about kids going into apartments. If you rent an apartment in June, July, and August, you ain't getting out of that apartment until June, July, and August. So new home construction, I think, and also home sales should start to appreciate. And we did see home starts accelerate last month. So with that said, I think some of the home builders will still look good, and we want to kind of focus. I don't want to just buy one name, though. And when we take a look at the ITB, which is the exchange traded fund on the whole the home builders ETF, you know, I saw a little uptick in volume. We're still not in a weekly buy. We had a long shadow, so it might be a little premature to get into this sector as a whole. So there wasn't really a whole lot. One restaurant, Darden, GameStop. I mean, you know, this does not show me that there is a lot of strength. In fact, we didn't have the financials in one sector that we still like and we're in and exposed to. I think that's the one area that's still going to continue to do well. We looked at a lot of different names like over the last few weeks, like American Express. FITB was another stock we loved, and it didn't do anything, and it was a sleeper, and it finally broke out. And of course, we got and picked off on Bank America. And so with that said, I think that we still need to focus in on some of the financials. Out of 25 high close dojis, 9 were in the financials. That says something. With that said, that concludes this week's planning and scanning. And if we see something further, obviously we'll be talking about it in this room this week. Everyone, have a great trading week. Thank you.